Hi everyone, this is Michael Kramer of Mach Capital. Today is January 7th and it's around 4 p.m. New York time. Welcome to 2025. And so far we've been off to a great start. Markets we're seeing a lot of volatility, rates moving higher, dollar continues to strengthen. These are some of the themes we were talking about going into end of year, and it looks like some of those things are starting to play out. So let's just take a look at the economic calendar quickly to get us up to date. Tomorrow we're going to be looking at ADP in the U.S., 139,000 versus 146,000. Now, U.S. markets are going to be closed on Thursday for the funeral of former President Carter. So we're going to be getting initial jobless claims a day early. We're looking for 215,000. Continuing claims, 1.86 million. Pay attention to the revisions from last week. These numbers have tended to get revised lower in the past, although last week's numbers were already pretty low. So just watch those revisions. The market pays very close attention to those, how those come in. Then, of course, at 2 p.m., we're going to get the FOMC minutes tomorrow. Those are going to be very important. We're going to go through those in just a minute. Then, of course, on Friday, we're going to be getting the payroll numbers. We're looking for 163,000 jobs who've been created versus 227,000 last month. The unemployment rate's expected to remain unchanged at 4.2%. Average hourly earnings expected to rise by 0.3%, down from 0.4% month over month, and remain at 4% year over year. The Fed minutes will take on some extra importance, especially given what transpired following the December FOMC meeting with the summary of economic projections. In fact, currently, Fed fund futures and Fed fund swaps basically saying that the next rate cut here in the U.S. won't be coming until July. And that's obviously a very big change from where we had been, 3-6 months ago. Markets now only looking for maybe one rate cut in all of 2025 here in the U.S. Not even sure if we're going to get a second by the end of the year. And it's starting to look like maybe 4% is going to be that long-term Fed neutral rate by the time this all gets said and done, at least when you start looking at Fed fund futures and such. And this is having a very, very big impact, especially on long-end rates here in the U.S. So we're just going to kick off with the U.S. 10-year. I know we normally don't cover rates, but it's really important to take note that you're seeing the U.S. 10-year break out above the 460 level. It looks like 475 could be next with an eye of 5%. And then, of course, when we look at the 30-year rate, that's already broken out above 4.8%. And there's really no major resistance in the 30-year until about 5.1%. So this is one of the reasons why you're seeing the dollar strengthen. Seeing the same things taking place in Britain. The UK 30-year today, the gilt rose to 5.25%. And this was the highest level on the 30-year in Britain since 1998. So this was a very significant move. Again, if you want to start talking about technical patterns, this looks like an ascending triangle, and it could just be the start of a much bigger move higher in the 30-year. Also, when we look at the 10-year JGB, we can see similar sort of movement here. It looks like a bull flag. We're breaking out on the 10-year, and when we look at the 30-year, also very similar patterns. We're seeing a move up to around 230. So rates globally just appear to be moving higher. You're even seeing them moving higher in Germany with the German 10-year back up to 2.5%. So surviving that big 198 area of support. So rates globally are moving, and what's really driving the currencies right now are, again, these spreads. And right now, because rates in the U.S. are moving particularly and Fed expectations are getting dialed back, not really clear when the BOJ, if they're ever going to raise rates again, although they keep hinting at it. Not really clear in terms of where the BOE may be going. This is really driving the dollar much higher against currencies like the euro. We've seen the euro fall all the way back below the 104 area and actually touch the 102 region. And again, the euro basically at this point just hovering around the 10-day exponential moving average. That's continued to be a very, very good litmus test for whether this thing is going to break out or not. You can see we just continue to use it as a resistance line. And I think as long as the euro stays below the 10-day exponential and can't really get above it for more than 3 days, I think it tells you that the euro is going to probably keep going lower, with 102 being support. Obviously, if we break 102, we're talking about going back to parity and slightly below to around 99.5. If we can break above this 104.5 area, it probably have room to move back to 106. But right now, the momentum is just not there for it. When we look at the pound, we've also seen that weaken dramatically. It wasn't too long ago that the pound was knocking at 135. Now the pound is knocking at 124. And again, just like the euro, we're seeing the 10-day really being the big level of resistance. We couldn't get back above 125 and a quarter today. This is obviously a big area of resistance with support at 123 and a half. Watch this level, because if you break 123 and a half, you're going back to 121 and a half or so on the British pound. And finally, when we look at the Japanese yen, it looked like for a while we were going to see the Japanese yen strengthen. Then that all went away because the BOJ has been really slow to make any changes since the summer. And now it looks like maybe you have some sort of bull flag forming in the yen. If we see the yen break out above 158, I think that opens the door to potentially test the highs at 162. It could even be resulting in the yen moving all the way back up to 164 and a half. So we'll keep an eye on this and obviously watch it. If we were to break the 156 level, that obviously opens the doorway lower. But at this point, the BOJ just doesn't really seem to want to do anything to alter this course. So right now we have to continue to work with the mindset that perhaps the yen continues to weaken. Copper's really been getting moving here. You can see copper, big downtrend in place. We finally broke out, rose above that downtrend, flipped above the 10-day exponential. Now we're watching momentum. RSI looks like maybe it's getting ready to turn. It's turning, moving sideways, looking like maybe it's getting ready to turn. Watch this right here. If we can get above, call it 420, I think it opens the door to 430 and potentially much higher than that. Then, of course, oil's really started to get moving here. It broke out the other day, rising above 71. Now we're moving up towards 74 and a quarter. I think the first real big test for oil is going to come at this trend line here, which probably takes us somewhere to around 77 and a half, $78. You can see the two converge here. If you can get oil through 77, 78, you're talking about maybe moving back into the mid 80s again. Certainly, we've seen a breakout even on momentum with the RSI trading above this downtrend that had been in place for some time. When we move over to the equity indices, there's really not been a whole lot that's changed over the last couple of weeks. Actually, the DAX just had a really big move down into the second half of December. Then it rebounded and moved back up. And this mostly, though, strength the last 2 days has come with some strength in the equity markets here in the U.S., although that really faded away by today at the end of the day here. So right now, I think you're watching this area in here for support at 20,500 or so. But I wouldn't be surprised with the U.S. equity markets trading down sharply today that you don't see the euro retrace and move back towards this 19,900 region. To no surprise, we really haven't seen the FTSE do much of anything, continuing to play ping pong between these two big levels of support and resistance. It looks like at this point the FTSE managed to get down to 8,000. Now we're moving back up. It looks like you can almost make a case that we're forming some sort of bull pennant here and potentially heading higher. We know we can use copper as a gauge. And if we start seeing copper prices moving up, I think you're going to see the FTSE move back up to around 83.50 or so. If you look at the S&P, like I said, it was a pretty rough day. This 58.75 area is a really big, important level. This was prior resistance. It became support after we gapped above it, the election. Tested it once, tested it twice, tested it 3 times. This is now potentially a fourth attempt maybe coming. We closed today at 5,900. This is really the line in the sand. If the S&P breaks 58.75, I think that's going to open the door to this gap fill at 57.75 and then potentially start leading to lower levels. It looks like you can make a case that maybe we have some sort of head and shoulders pattern that formed. Depending on how we start moving lower, if we continue to move lower, if we were to gap below the 58.75 level, let's say we gapped lower in the next day or two and we opened somewhere around 58.50, that would potentially set up this not only as a head and shoulders, but maybe even an island reversal top, and that would also be obviously a pretty negative indicator. So right now it looks like the S&P has just been sort of consolidating, maybe forming some sort of consolidation or distribution pattern. So I would keep an eye on this 58.75 level. As long as you stay above that, I think you're probably okay. On the NASDAQ, it's really very similar, with that level being around 20,850. This was post-election. We moved up. You can see we came down it, but here was your trend line. That trend line is obviously broken. We came back and retested it yesterday. We failed at it. We came back down. I was also making a case at the time this was a diamond reversal. Here's your trend line. We came back up to that trend line 2 times now. We tried to get above the trend line and failed. Here's your 10-day exponential moving average. This is what I mean when I say if you can't get above it for more than 2 or 3 days. We got firmly above it yesterday. Today we closed back below it. And again, this could be an indication that that trend is starting to turn over. A break below this 20,850 area sets up 20,280. And then finally, the Dow. The Dow has really been the weakest of the indices. At this point, the Dow just looks like it is consolidating sideways after a pretty sizable drop that started in the beginning of December. Again, you can make a case here if you can make a case that, the yen is forming an ascending triangle. You could start making a case that the Dow is forming a descending triangle, which would suggest that the next major move for the Dow is going to be lower. But as you can see, 41,900 is a very important level. If that level breaks, then you're likely going to start seeing a bigger move down, and that would catch a lot of people's attention. You can clearly see where we hit sort of oversold levels, but there's still plenty of room to go to the downside here for momentum. So, with rates moving higher, with a stronger dollar, it certainly would make sense from a fundamental standpoint to see equity markets start weakening, because financial conditions as a result of higher rates and stronger dollar means tighter financial conditions, and that usually leads to lower equity multiples. So if you start tying it all together, you can certainly make that technical and fundamental case tie together. And that's something to keep in mind. The higher rates go, the more dangerous it's probably going to get for stocks, which really makes these Fed minutes critical, and also the job report critical. And then, of course, CPI next week is going to be equally as important as we go into 2025. Anyway, have a great start to your year, and we'll see you again next week. Bye.